do more when you can do more of that dynamic. But good morning, and yeah, I'm really happy to be with you. And the bottom line is that we want to talk about what's happening in the world of 1031 exchanges, how to prospect for new sellers. Um, we need a little more inventory on the market. I know there is a little more, but we need other types of inventory on the market too that makes it better for replacements. And our goal is to help you not just understand this process of the 1031 exchange, but it's to help you develop more business for yourself. And the more business that you have, the more you'll pay dues to be part of the board. and and the bottom line is that it'll help you in your career. So without any further ado, let's jump in. Oh, by the way, that QR code right there gives you all my contact information, my phone number, my email address. So please feel free to join in. In fact, I just saw Mr. Alan Mon joined us. Hello, Alan, and he's my friend. So here we go. Like any type of seminar, you want to make sure that that what happens in every situation is you always make sure that two things don't happen. You don't give legal advice and you don't give tax advice. Why? Because legal advice and tax advice are something that you can't give without having a license. And this PowerPoint is not designed for that reason. It's for the reason of keeping you on the straight and narrow. So you can talk about how to grow their business and how to understand the 1031 exchange, but by the same token, not kind of go over to the dark side where we're not licensed. Because the last time I checked, E&O, your E&O and mine does not cover giving out legal or tax advice. So we have to be very careful about that. First thing I want to talk about is something that's beginning to come to an end, and that's the Los Angeles disaster extensions via the fires that we had back in January. Here is, it's almost August, right? Another week and a day, it'll be August 1st. And the deal is there's still a fire extension. Was there even a fire extension? The answer is yes, there has been. An affected taxpayer for this is that you either live in Los Angeles County and you may participate then for these extensions, or if you sell your relinquished property using an entity, and if the principal place of business for that entity is in Los Angeles County, then your entity qualifies also for this extension. So what's left of the extension right now? Oh, by the way, I'm happy to provide this to you, and you can provide these extensions to your clients. However, they need to talk and have a discussion with their CPA to find out if the CPA feels that they qualify. I think it's kind of simple. Well, we figure that they probably do, but the bottom line is we can't give out that kind of advice. We have to be very careful. So we ask them to take this information, talk to their CPA, let them look at the tax code, and to decide whether or not your client qualifies for these extensions. The last one that we're in right now, as far as new business is concerned, is the last bullet point towards the bottom. It says that if your relinquished property closes escrow after April 18th, but before August 31st, then you will receive an extension on your identification deadline until October 15th. You'll still have to complete your 180 days to close your exchange, but they push down the road the identification period. We're going to talk about that identification period in the seminar that we're doing this morning, but I just wanted to clarify that you only have the first 45 days after the sale closes to identify replacement property. If you close in the next few weeks, you have up to October 15th to identify, and 180 days, of course, beginning the close of the sale to close what you're going to buy. That identification period is what torpedoes the majority of the exchanges that fail. It doesn't destroy the exchange. It's just for those who fail, it's the identification and the failure, to find something that you really want to buy and exchange into. So please get a copy of this, and we'll be happy to provide it to you. Send me an email. I'll show my email address again at the end of our time together. And if you didn't get a chance to take a picture or jot it down or look at the QR code. But yeah, this is a big deal, this extension of the 45-day identification period. Next, what's motivating right now people to sell and buy? It's really the constant motivation, usually in most markets, whether an up market, a flat market, or a down market. It's usually a monthly income. Folks, I own investment property, and I'm sure a number of you out there that are watching today own investment real estate as well. Well, the number one reason or the motivation is monthly income when you get in front of people who own these properties, because we buy property so the property will work for us so we don't have to. And that's super important, because if you have one front door, whether it's a single family, condominium, maybe it's even a commercial or industrial building, but if you have one front door, you can expect to get paid a rent check every month. Number two, if you have 4 front doors, 4plex, 4 condos, whatever, you can expect a paycheck on an average in a month period once a week. If you have 30 front doors, you get paid every day. Yeah, because there's 30 or 31 days in a month. So yes, I know there's February, but the bottom line is that people buy because they want to see cash flow, but what they don't understand is the rate of return. This is something that's going to really equip you to be able to, when you speak to your prospects, to help you get an opportunity to talk about something that may really make them rethink about listing, that to do so. We'll talk about that in a few minutes. The second thing, again, it's all important to talk about what's important to them. The second thing that's most important is appreciation over time. You know, properties always appreciate. We have cycles, just like we have a winter cycle, a spring cycle, or a season. We also have fall and then back to winter again. And it just keeps repeating over and over. Well, the same is true with the economic cycle, but especially in the area of real estate. It goes up in value, and then after it peaks, it goes down, and then it comes back up. But usually, at least since in my lifetime, after it goes down, it goes back higher than the previous high. So you could always expect that the property will be worth more over time. Even with people exiting California, it's still going up. And it's amazing because they're obviously selling to somebody who wants to buy, or people who want to live in here. We've seen 2 phenomenons of people leaving California, and we've also seen a number of people come back because of the appreciation thing. So super important. And the key to appreciation is not putting all your equity just in one property, but to be able to utilize the appreciation to buy more property, to have more properties that are going to generate cash flow, and they will also all go up, as opposed to putting all your appreciation in one basket, or in this case, one building. What's the third thing that matters most? Taxes. The big murmur now is, all the stuff with the new tax bill that just got passed about a month ago, 3 weeks ago, whatever it's been. And this is a big deal to investors. A motivation is to be able to reduce the taxes they pay off the rents they collect. Also, to reduce or eliminate taxes, to sell the property and to go into better properties elsewhere that would be better for their income, appreciation, and the tax write-offs. So 2 things I want you to know about this, because we only have an hour today. Number one, there's 2 basic types of tax write-offs. The ones you take in the year that you do the repair it. For example, if you paint, carpet, you fix something, those are just general. In fact, even going to the property and visiting the property is a deduction, in terms of mileage. The government, if you buy properties other places, like in Las Vegas or wherever people are buying, the bottom line is that you have to travel there. You get to write off your mileage, you get to write off your hotel, you get to write off your meals. Get you to write off your gambling? No, that's not included. But certainly those types of things allow you to have a write-off for the purpose of reducing taxes off the rent you collect. That's a deduction that you take in the year that you spend money in. There's a second kind of benefit of tax write-offs in real estate. It's called depreciation. If you look at the left side, you see where it says in red, residential 27.5 and commercial 39. Let me explain to you what that means. What it basically means is this: when you buy the property, or whenever you bought the property, and it's going to be used for rent or productive use in a trade or business, your CPA is going to look at that purchase price, and they're going to break the purchase price into two categories. The first category is the value of the land. The second category is the value of the improvements or the buildings on the land. So let's say you bought the property for $1 million. So your CPA will break the $1 million into two categories: land value and building value. Land plus building equals your purchase price. They will take not the land value, but the improvement or the building value, and they will divide it by either 27.5 or 39, depending if it's residential or commercial. So if it's a condo, obviously it's residential. If it's a duplex, it's residential. If it's an office complex, or if it's a shopping center, or if it's, whatever it happens to be, it's commercial. But what if it's a 150 unit apartment building? The answer is it's not commercial, it's residential, because it's housing. Now, you'll have to pay for a commercial loan to be able to acquire that condo or that single family. I'm sorry, that condo. Oh, yeah, it's true if it's going to be a rental, but they'll charge you a higher rate if it's over 4 units. So if it's 5 units and above, the lender usually gets more. And the bottom line is because it's an investment. And so herein lies the thing, is that if you have a 150 unit apartment building and you bought it for, $10 million, you'll take the 10 million divided by 27.5 years, and that's how much tax write-off you'll be able to take with your depreciation off the rent you collect. It's a big deal. It's a huge deal. It reduces the rent. And the nice thing about residential, yes, you're taking it over a shorter period of time, but you're getting bigger amounts each year for 27.5 years, as opposed to less over a 39-year span of time. I don't know how many people are going to hold their buildings for 39 years. Frankly, I'm not sure how many are going to hold them for 27.5 years. But the bottom line is, this depreciation thing is a big deal. Why? Because it allows you to reduce taxes on the rent you collect. What else is depreciable? Well, let's say you do capital improvements to the building. What's a capital improvement? Is it like paint and carpet? No. Those are just write-offs. A capital improvement is getting rid of the windows and going to double pane windows, or energy efficient, this, that, or the other thing. As an improvement, you could remodel, upgrade, get rid of the roof, replace it with a nicer, better roof. The bottom line is that they're going to give you whatever money you spend on the building after you acquire it to create a second layer of depreciation. The first layer is that 27.5 that was divided by the value of the building. But since you're putting in a more improvement into the building, whatever you put in, so if you put in $100,000, now you're writing two depreciation schedules: the original one for the building, for its building value, and number two, a second layer of depreciation for the improvements, the capital improvements that you put into the building. What's the whole thing? Is to make the purpose is to make the building more valuable, and number two is to reduce the taxes you pay off the rents you collect, because the more you make, the more the government takes. And in this, they're giving you tax breaks to stimulate you to do things to your building and to keep it up to date. So these are the three things that matter most. I know, because I own investment property. I want it to produce monthly income. I want it to be worth more over time. And I want to constantly have tax breaks because the government, these things push me up in higher tax brackets because they produce income. But the question is, how do I make it work harder for me so I don't have to? And these are the strategies that we're talking about, not just to understand about the 1031 exchange, but how do you get in front of people? And what do you talk about when you do? And there is a way to find these people who own these investment properties. It's called a farm package. You talk to your favorite title person. They will give you a ownership list of rental or business use properties in any given area, as long as you tell them what you're looking for. Are you looking for condos that are rented? Are you looking for single families, 2 to 4 units, 5 units and above? There's a myriad of all types of investment property. Vacant land is investment property. Why? Well, it's not producing income, but you're holding it for appreciation purposes, so it qualifies. So how do we get them to take a look at the income thing and how hard it's working in terms of producing money for them? Now, obviously, vacant land doesn't do that for the most part, but how do you get a chance to use the cash that you have that's grown? And by the way, what's the rate of return on that? You know, most people don't even know what that means. What's the rate of return on your building? You know what they say? This is what they say. I'm going to show you. See, I bought it for this, and now it's worth this. It was great. Wish I bought another one, or 2 or 3. My rents were here, but now they're here. Life's good. Rents are higher. Property values are higher. Wish I bought another one. But that's not a rate of return, folks. That's just how the property is doing. My question is not what the cap rate is. My question is, what is the rate of return? Give you a simple example. If I had, let's say, $1 million of equity in a piece of property, and I take the $1 million of equity out of the piece of property, I refinance the building, and I put the money into another building, or no, better yet, not another building, but in the bank. If I put the money in the bank, which is probably a bad decision, but if I did that, what would be my rate of return? It's fairly simple. It's 5%, 4%, 3%, whatever the bank is giving me in terms of an interest rate. So the equity leaves the building, goes to the bank. They give me, let's say, a 3.5% rate of return. That's probably a little closer to what the norm is right now, depending on where you shop. That's your rate of return. So my question is, what is your rate of return on the building that you're renting out? And if you have 2 buildings you're renting out, you do one of these for each building. If you have 150 unit or 150 buildings, you do this 150 times. This tells you, because you got to know, what am I getting back? Because some people, if they even have a concept of what this means, they'll say, well, you know, I'm probably getting at least 10% return, maybe 15, maybe 25%. Some people have told me they're getting close to a 50% return. And I said, that's fantastic. But what did you base that on? What formula did you look at? So what I did is I shopped around with a bunch of CPAs, a couple of the ones that understand real estate that I worked with over these last, well, you know, I've been in the industry since 1982, right? First it was in the title end, but the last 27 have been in the 1031 exchange end. So I've gotten more interested in these types of things in these last 27 years. And I've asked the CPAs, how do you do this? And this is what they came up with for me. Number one, the gross income. To determine what your building's average rate of return or interest rate on the equity in the building, because that's what belongs to you. You sell the property, you get to keep the equity minus the cost. So first thing you do is you got to figure out what the gross income is per building. So if I'm doing this on a 4-plex or 1-plex or whatever it happens to be, I'll know because I declared this on my tax return every single year. So monthly rent times 12 equals my gross income. But number 2, it's not how much you make, it's how much you keep. So now you have to back out all your expenses, because that's outgoing. It doesn't matter. That includes, by the way, like I said, we're not factoring cap rates here, your monthly mortgage payments, your insurance, your property taxes, your maintenance on the building, your utilities, whatever you're spending on the building. If you have to evict somebody, you have to hire a lawyer. If you do a tax return, you have to hire a CPA. There's just any little things that have to be done. Those are your expenses. Number 3 is your net. The sales price minus number 1 minus number 2, the expenses, equals your net. Next, that's number 3. Number 4, how do you estimate your net equity? Because you have to figure out what the equity is that you're going to take out in the building and put it into a bank account or another property or whatever. Question is, how much is your equity today? Everybody guesses, but the best formula is this. You, the agent, figuring out what the fair market value that this property should sell for based on the condition and the location that it's in and the features of that building, right? So you comp it out. What should it sell for, roughly? Fair market. Number 2, you have to subtract the debt or the mortgage on that building, because you may have a HELOC or a first in a HELOC, a line of credit, hard money, whatever. Whatever debt is going to be paid off in your mind at the close of the sale, that has to be estimated and taken out of the fair market value of the property. So the fair market value minus existing debt against the property equals your approximate net equity. Lastly, to figure out what your rate of return is on your building, you take the answer to number 3, the net income, and then you divide it by number 4, the net equity. So the net income divided by the net equity equals your approximate rate of return. Just like I said, if you took everything out of the property in terms of equity, put it in the bank will give you 3.5, 3.75% return, whatever it happens to be. Question is, what is your building doing in this? And guess what? They guess 15%, 20%, some say more. They've had, the higher the equity is, obviously I'm getting a better rate of return. At least that's what they're thinking in their mind. And the question is, are they accurate? Here's the answer. No, they're not. According to these CPAs who specialize in real estate, that the rate of return is going to be something very close to this formula. Now, there's things that we can't factor in here, like depreciation, because everybody's schedule is different and most of them won't even know. But the bottom line is, this is going to give you an approximate rate of return. What do you think it is? What do you think most people would guess? Well, we already told you what most people guess, between 10, 15, 20, 25% or whatever. The average rate of return, and there's no such thing as average because not one individual is that average for the most part. It's usually a range. The average rate of return for investors who've owned their properties for roughly 10 or 12 years or longer is somewhere between, are you ready for this? Between 1 to 1.5, as high as 4.5%. You say, what? Yeah, between 1 and 4. Now, some will be higher and some will definitely be lower. Why? But I've got all this equity. You've got a problem. Equity is a wonderful thing, and we want the building to increase in value. But your rents can't increase based on the values of the property or the appreciation of the property. Because as the property appreciates, you're not getting enough income to justify a good rate of return. So appreciation is outpacing rent growth, which means the rate of return is going down in the building. And many investors don't realize that until they do the math. Or when they finally realize that maybe paying off a property is good if you're maybe retired, but it doesn't make sense before that because it's not working hard. It's going down. You're getting very little back for all the equity that's in the building. So what is the solution, to this? How do you get a building or buildings that can do better for you? Here's the answer. You can sell it, but if you sell it, you're going to pay taxes on it. Yeah, I mean, I even heard murmurs. People have been talking about raising of the principal residence exclusion from $250 to $500, and the $500 to maybe $1 million. I've even seen articles just recently where the White House is talking about the possibility of eliminating capital gains taxes 100% on your primary residence. Boy, would that generate a lot of sales or what? But the whole point is that today you sell, you pay taxes. How much? Remember, you can't factor this up for a client, but this is my suggestion, is when they go to their CPA, they're going to give this is like a flavor or a taste of what it looks like. If you sell a property for $1 million, as an example, I know I'm going back and forth on sales price on different illustrations. There's no rhyme or reason for it. It's just the way I wrote the thing. If you sold it for $1 million and you bought it for $300,000, your approximate gain is going to be around $700,000, because this tax on capital gain, you might be surprised. It has nothing to do with how much equity you have in the building, because you possess the ability to refinance and take the equity out. So you don't pay a capital gains tax because you refinance the building. You pay a capital gains tax because you sold, and you're trying to releverage and do better with your rate of returns. So the purchase price is really not the purchase price. It's called your adjusted basis. And that's what the CPA is going to factor in. How do you come up with an adjusted basis? You add in capital improvements, you deduct depreciation, you add in closing costs. It really gets involved, and you and I are not licensed to do that. I'm just giving you a taste of what this looks like. So the sales price, number one, minus the adjusted basis, not what you paid for it, but really the adjusted basis, number two, equals your capital gain, and that's what you pay taxes on. So if I sell it because I want to do better, and how do I do that? The answer is, well, you're going to pay taxes if you sell it. What kind of taxes? Well, there's 4 taxes you pay when you sell a rental or a business use building. Number one, you pay the long-term capital gains tax. Remember, that has nothing to do with equity. Your capital gain is going to be on average around 15, as high as 20% if you're in a higher income bracket. Number two, that money, that 15 to 20% of that gain we just showed you on the last page, that goes to the IRS. Number two, if your gain is over $200,000, you pay an additional 3.8 to the Medicare or the health care program, also known as the Affordable Health Care Act. When they passed that as Obamacare a number of years ago, it came with a price tag, because you don't get benefits without tax increases. And the bottom line is, it's an extra 3.8 to your capital gain. Does it apply to your rental property? Yes. What about your second home or vacation home? Yes, it does. But your principal residence? It does. Stocks, bonds, mutual funds? Yes. So that's an additional tax to the gain for the purpose of the healthcare program. Number three, California state tax. California doesn't charge the capital gain on the real estate. It charges ordinary income. So the ordinary income tax rate is going to be somewhere between 9.3 to 14.4. But remember, when you sell the property, because it's not a long-term capital gain to the state, it is a ordinary income tax. Then anything else that you earn for that particular year, in terms of your earnings, whether commissions or your salary or whatever it happens to be, it raises the tax bracket on everything that you made that year. And you might be closer to the 14.4%. That used to be 13.3. It's 14.4 now. And then lastly, all the depreciation that you were able to take or allowed to take, whether you took it or not. Remember, that's called allowable depreciation. Well, you have to pay a tax on it. He said, well, but that was the benefit is, they say it is the benefit. You keep 75% of it. But when you sell it, they want 25% of it back, whether you took the depreciation write-off or not. By virtue of the fact that it was depreciable, you could have taken it. And if you opted not to take it, you still paid the 25% tax. So if it's $400,000 worth of allowable depreciation during the time that you own the property, you pay a tax of 25%. 25% of 400,000 is 100,000, plus the California state tax, plus the Medicare healthcare tax, plus the long-term IRS capital gains tax. You say, I'm not willing to give 30 or 40% to the government here. Is there another way? Yeah, don't sell. And that's not really a good alternative, is it? Especially for us, in the real estate profession. So the government back in 1921, yes, it was before I was born, created something called the 1031 tax-free exchange. No, it's not tax-free. It's tax deferred. What does that mean? Well, you're supposed to pay this, what we just showed you, when you sell. They're saying you don't have to if you do this. And if you carry the basis forward and the equity forward and buy equal or greater than what you sold for, whether you put it in one building or multiple buildings, you can grow your income, appreciation, and tax write-offs without having to pay this. It's amazing. This has been in jeopardy a number of times over the last several decades, but the exchange continues to win out because it stimulates the economy. It allows investors to sell and buy. And when you sell and buy, you're paying for commissions. You're paying for escrow fees, entitle fees, transfer taxes, recording fees. You're putting a lot of people to work, appraisers, insurance companies. I mean, a lot of these companies and people that get paid, fix-it people, whatever, accommodators like me, what happens? Well, we all get paid. And when we all get paid, two things happen. We have to pay taxes on the income we make. And number two, we go out and spend. And when we spend, we stimulate other businesses. And the more they're stimulated, the more they have to hire people, the more they pay taxes on the wages, and they go out and spend as well. It was a brilliant idea back in 1921. I don't know how they foresaw this and how it would impact the economy, but it is wonderful. It lets you go into better properties that give you a higher rate of return instead of the old one that is, the longer you hold it, the equity goes up, but the rents don't seem to ever catch up. And especially with rent control, that even puts more of a stress and a burden on it. So you say, well, but I can keep deferring tax, but don't I have to pay it eventually? Yeah, you do. If you sell and not do any more 1031 exchanges on these investment properties. But is there another way? Because I don't want my heirs to have to pay this kind of tax. I mean, my trust or whatever my portfolio is in my entity that's, after I die, my estate, they're going to have to pay all kinds of taxes. Now, if you have a trust, and this is only one way, there are other ways of doing this. Look at the bottom in the reddish maroon color, burgundy. Your clients must consult their tax professionals or estate planning attorneys for more details and alternative methods. In other words, when you die, if this property is in a trust, let's say I pass, it goes to my surviving heirs. Number one would be my spouse. I might have all these heavy capital gains that I've been deferring on and on and on with a lower basis, with a higher gain. But the day I die. The basis dies with me. Then the trust takes on a new tax identification number. And whatever the value is at the date of my death of all my assets, my stocks, my bonds, my mutual funds, and all my real estate, including my personal residence, my second home, my vacation homes, and all my rentals or business use buildings, go from the basis that died to the fair market value at the date of death. Which means if I bought it for $1 million and now it's worth, I don't know, $10 million, they inherited at $10 million. And there's also something called an estate tax on top of all these capital gains taxes that your estate will pay between 35 and 55% tax. But because of the new tax act that just solidified and kept the stepped up, not only stepped up basis, but allows like the salt thing and everything else that is involved in it. What happens is now if you're I think it's $15 million per person. So that would make it $30 million per husband and wife. That whatever is what with the stepped up basis, the heirs pay nothing under the $15 million a person, which means they don't even have to pay the estate tax. This is incredible. This is why, because this is the largest transfer of wealth our country's ever seen, because the baby boomers are beginning to die. I happen to be a baby boomer. Thank God I'm still alive. But the bottom line is that there's going to be a tremendous amount of transfer of wealth in our country. And when you set it up with a estate planning attorney, and you pay what, between $2,000 and $5,000, $6,000 for a trust to be able to have this with the stepped up basis. And then, when my wife dies, then it goes to our kids at another stepped up basis again. You have to talk to the estate planning attorney. They'll set up the right kind of trust. And many people tend to elect going the route of a trust that is a revocable trust. Revocable means you could revoke and change the content of who gets what, or this person's out, this new person's in, or this is going to be distributed over certain periods of time. You get to do whatever you want to do. Even when you're dead, it's all going to be carried out. It's an incredible estate plan. And you need, as an agent, you need to have people, estate planning attorneys and CPAs that you work with that you can refer out, because they will help your clients. So let's go back to the 1031. What properties are eligible? Only one. It's in the far left-hand box. Real investment, real estate only. The definition of real estate that you're holding is holding it for 2 years or longer. Now, some CPAs will say, well, that's more like 2 tax years. Some say, no, it's 24 months. Let them make that decision for your client. But if they've been holding it for 2 years or longer, they're eligible for tax exchange status. If it's going to be one of these 3 things to the right. Number 1, did you hold it for income? You charge your rent. The answer is no problem. As long as you're declaring it on your tax return, the rent, taking your depreciation, it qualifies for a 1031 exchange. You don't have to pay any of those taxes to defer what we just were talking about. Number 2, if you're not renting it out, but you're occupying the warehouse or the office space, or it can even be residential building, if it's for business use, then that property or that part of it, if you're living in part of it, that business part of it, or the entire building, if it's commercial or whatever it happens to be, can be exchanged. Did you notice it doesn't say residential commercial on here? Because it doesn't matter. If it's residential commercial, whether you're renting it out or you're occupying it for your business as a business site. Number 3, vacant land. We already said that. Vacant land can be held for appreciation. You can exchange any of these 3. And where can you go? The answer is into like-kind property. But what does that mean? Well, some people say, if I'm selling a single family, I have to go back into a single family. That is not what like-kind means, folks. That is a common mistake. We're going to talk about things like that today. This is one of them. Like-kind does not mean a single family for a single family. Yeah, but what if I want to go to a single family to, let's say, a 4-plex? That is like-kind. Well, but it's different. One's 4 doors, one's 1 door. It has nothing to do with it. Like-kind is the sale of any investment real estate. And we just showed you there's only 3. You either hold it for income, you hold it for business, or you hold it for investment of vacant land for the purpose of appreciating. And with the sale of any one of those 3, you can go into any one of these 3. So if you want to sell a property here, like a single family rental, and buy a triple net lease building that you're going to lease to Chick-fil-A or Starbucks or Home Depot or whatever it happens to be, that's like-kind, because you're going out of property held for income into other investment real estate, either for business or income. That's wonderful. What does that do? That gives us the opportunity to change the kinds of buildings we're in, as long as we're going from investment real estate to investment real estate. It's incredible. And you can buy these properties anywhere in the US. So if you want to get out of California, and by the way, I've got a number of marketing letters that goes over already some of the stuff that we've already covered today, plus some of the others that we will. I will give it to you, including this one. This one talks about why investors are leaving California. And I don't know if you've thought about it, but many of them are for two reasons. Number one, rate of return. They can get a much higher rate of return in other states. You say, but the values are less and so are the rents. That's true. That means you're going to have more buildings with rents that proportionately to the value of the property are higher in other states other than New York and California than it is here. And that's why we've seen an exodus. That's part of the reason. The second reason is California is not very balanced. It's very, very to the point where they have their favorites. And one of the favorites they have in our world, called investment real estate, are tenants. They give tenants more rights than they give the landowner. They tell them in many cases they don't even have to pay rent because of certain situations that occur. It's just, people are just frustrated. And I hear about this on a daily basis from clients who want to leave, maybe go out of residential, go into a triple net lease property or a DST or some other properties that they want to own in other states where the laws are more balanced. You got to have balance, both for the tenant and for the landowner. It's just important that everybody gets, balance in terms of law and protection. And a lot of them here in California feel like that's not happening, and that's why many of them are going away. What's not eligible at 1031 exchange? Your principal residence, never. Your second home, nope. Vacation home, nope. Business, property, yes. The business in the property, no. Flipping, no. Because when you're flipping property, you're not renting it out. You're not occupying it as a place of business for 2 years. So flipping really, for the most part, is risky. Now, you may want to take that risk if your CPA will allow you to, but if you get audited, that CPA has to protect that. So what about your primary residence, but you have, let's say, a fourplex and you live in one of the units? Well, on the unit you live in, you get the 121 principal residence exclusion, up to $250,000, up to $500,000, but only for the part that you live in. For the remaining part of the buildings, you can do a 1031 exchange into other investment real estate. So it's just simply fractioned out or proportionally distributed by the CPA, and they'll tell you how they've been writing it up as investment versus principal residence on their particular tax return. So yeah, they can do an exchange on the investment portion. I'm going to skip some items because I just looked at the clock, and this is only supposed to be about an hour program. Maybe we'll run about 5 minutes late, but I really don't want to go beyond that. So there's a lot of things we need to cover. Number one, when you sell the property, I want you to look at the red at the bottom. Your seller needs to hire a company like ours as a facilitator or accommodator, be with and get it set up with escrow and have them sign the exchange documents before the escrow closes. Every week I get a phone call. I need to set up an exchange. I closed yesterday. I closed a week ago. I closed a month ago. And it's just too late. The government will not allow our industry to backdate documents. If somebody or an accommodator is willing to do that, that's considered tax fraud to the accommodator and to the taxpayer who's getting the exchange done. And frankly, you might be named in the lawsuit as well. So be careful. Remember, talk with the accommodator, a company like ours. There's some good companies out there. There's some bad ones too, so you have to be careful. And we'll see if we have enough time to talk more about that today. But the bottom line is you need to set up a 1031 exchange, which means the best way for you as an agent is to take into your contract the SXA zip form. The SXA zip form is this. it allows you to tell the buyer that the seller is doing an exchange. There's no tax liability to you, there's no cost to you, but the seller needs to bring in their accommodator or their qualified intermediary. Some people call us a QI for qualified intermediary. But the bottom line is we've got to get all this set up before escrow closes. And the second thing this does, if you need to, you can manipulate this seller's intent to exchange form into a negotiations for the purpose of a contingency to say, look, at the end of our 30-day, 45-day, 60-day escrow, whatever, if my seller has not found the property yet, because once you close, you have 45 days, right? And you saw the extensions, but those are running out here. So the bottom line is you've got the ability to negotiate an extension. Why? Because you see this 45 days to name doesn't begin until you close the sale. So all you're simply doing is extending the sale. So you're not closing and you're not starting that. I have one of these right here. I'll show it to you. One of these little time clocks, right? These egg timers that starts the 45 days from happening. So really quickly, the only two exchanges that I want to talk about today, because we don't have time for any of the others, we might come back and do an advanced class. I'll check with Rick and Johanna. But the bottom line is I want to talk about the two that matter most. Number one, or the two that are performed the most, is called a delayed exchange. Delayed means you can't close simultaneously. So you have up to 180 days from the date of closing to close what you're going to buy. Number two, and that's going to be like-kind investment property. Number two, it has to be named in 45 days. It has to be on what they call the identification sheet. At the end of day 45, you can have up to 3 different properties. Property 1, property 2, property 3. You can buy all 3. You can exchange it to 3, or you can exchange it to 2, or only 1. The goal is to buy for equal or greater in value. However, whatever's not on that list at the end of day 45 may not be acquired through this 1031 exchange. Only what's on the list. That's why this fire extension is such a big deal. That's why this contingency on the SXA form I showed you is so important. It gives you more time to locate the property, because once you close, that's when that egg timer I just showed you starts for the 45 days. The next is called a reverse exchange. We don't have time. This is like a 20-minute discussion of the reverse. Let me just put it as simply as I can. The government allows you to close a purchase of a new replacement investment property first through the accommodator, and then close your sale up to 180 days later. So you're doing this backwards, or that's why it's called on the street reverse. They'll let you do that, but only with the accommodator. There's a lot of intensity that goes in there. This is not even the tip of the iceberg. It goes way down. When we do an advanced class, I'll spend more time with it, but just know that your accommodator, not every accommodator does this, a reverse exchange. We do. But the bottom line is it allows you to close the purchase first. And for clients, that might be a really good method, a way of waiting to the right property, because they know they can close the sale. They're just afraid they won't find the right property in the 45 days. This is a great exchange. More about that at another date. Well, we're going to pass all these other types of exchanges. I need to talk about this. These are the IRS's, and this is another area where there's so much misunderstanding. What does the IRS require in a 1031 exchange? 2 things, and this is 1 and 1. We have a typo, I see. It's 1 and 2. Number 1, we are there to reinvest all the cash from the sale. The goal is, let's call the exchange a different word. Let's call it a trade. You're not trading with the same person. You are through the accommodator technically, but you're selling to one person. You're buying from a different party. So the whole point is that you're not supposed to touch money. All the proceeds from the sale must go into the acquisition. Number two, this is number one on this slide. If you're selling a property that you have an existing mortgage or multiple mortgages on, they will be paid off at the close of the sale. But they must also be reborrowed back because the government says you can't have any debt relief after closing the sale to the time you take possession of the new replacement property. You must leverage it or take on as much debt on the new property equal or greater than on the old property you sold. And all the cash must go. And that's what equal or greater really means, but I'll show you more specifically. They'll allow you to take out the non-recurring closing costs. Recurring, not allowed. So if you want to fix the property, do maintenance to the property, upgrade the property, do capital improvements to the property, pay property taxes, insurance. These are all ongoing types of things you have to do to maintain a property. HOA fees, whatever it happens to be. Those aren't allowed to come out of the proceeds of the sale, but only the one-time cost to sell the property. What is that? The commissions that you pay to sell the property, the escrow fees, the title company's fees, the transfer taxes that you'll have to pay, the recording fees, our fees to facilitate this exchange. And the last one is really cool. Any contractual agreement between seller and buyer. What does that mean? Well, that means, for example, let's say there's some problems with the property and your buyer notices it and asks the seller to fix it or pay for it or credit them for it so they will pay for it. Those are maintenance items, or they might be improvement items. I said those are recurring. They're not allowed to be paid for. The government said the only exception is if it's a condition of contract or a condition of sale. So if the buyer finds out these things need to be done, they negotiate, they put it in their contract for the seller, or amend their contract for the seller to say, look, we need you to fix this, or lower the price of the property, or better yet, give me the cash to do so, and I'll do it after I acquire the property. You may do it because it's a contractual obligation between seller and buyer. It's perfect, and the government will let you do that. So if I sold, there's another sales price difference. If I sold for $3 million, let's say the non-recurring closing cost is 200. We're just using round numbers to make it simple. So 3 million minus 200 equals 2.8. If you look at number 6, it's the same number, 2.8. That's your new minimum purchase price because you're allowed to pay for the non-recurring cost to sell. There's a couple of non-recurring costs to purchase now because as a buyer, you might have to pay commissions to the agent to represent you if the seller isn't willing to do that. So that is an issue. That's a one-time cost to acquire. A loan never, ever factors in as non-recurring closing costs on an acquisition, or anything that the lender requires. It is not involved. You can pay for escrow and recording fees and things like that, but not services as a recurring cost. So it's basically on the non-recurring side. So 3 million minus the 200 leaves us 2.8. But remember, we have existing loans on the properties. Those have to be paid off. That reduces my 2.8 to 2 million. So I have to buy for 2.8. We already determined that. So how do I get back to 2.8? The answer is reborrow the loan. And the government allows you to do this in various different ways. A new mortgage, you get a new lender, you get new cash that you have in the bank or wherever you have. You want to put it into the acquisition to replace the loan with it. That is allowable. A seller can carry back for you. You could assume the seller's loan if it's assumable, or any combination of the above as debt or mortgage replacement. We put the EMD in from the sale to the purchase. My eyes on the clock, so I'm watching it fervently. We will do that for you as long as the sale is already closed and we're holding the funds at that point. and then we're going to put the funds into the acquisition. So if the client needs an EMD forwarding from those funds, they just request it in writing, and we make sure that it's them, and then we will forward the funds to them. If for some reason the exchanger is not in escrow on their purchase, but they want to get into escrow on another purchase, they still maybe want to do a delayed exchange or reverse exchange, they put in their own EMD money. And then when it closes, they're allowed to ask escrow for reimbursement of what they have to put in terms of EMD money for their acquisition, because their sale hadn't closed yet. That is allowable. That's not taxable. Be careful when you choose an accommodator. They have to be safe. They have to be, they have to disclose everything to you. You need to ask good questions from the accommodator. Make sure they never commingle your funds with anybody else's funds. It's a disaster waiting to happen. Number two, the money must never be in their corporate account, ever. Number three, the taxpayer should always authorize a release of funds in writing for the account. It's got to be in writing. Make sure they have plenty of bonding, errors and omissions insurance. Make sure they have a lawyer on staff. Sometimes a CPA on staff would be very helpful as well. These are things companies like ours do, but not all of them. And you just have to be very selective when I'm not telling you to use my company. I'm just telling you to be selective, to make sure that you've got a company that's going to really stand back and protect and secure those funds and do the right thing for your client. There's other things that we can talk about now, but unfortunately, we're just about out of time. No, you can't go into a REIT. Yes, you can go into a DST. I'll get more into that next time if we come back. Can I buy into an LLC or partnership? The answer is no, but you can take title as tenants in common with somebody like an LLC or another party. We'll talk more about that next time. Can I exchange into property I already own to build, like an ADU? The answer is generally speaking no, because you're not buying anything. You're just building something on land you already own, whether it's a rental property or a personal residence. Can I pay off other loans on other properties I own? No, because it all has to go into the acquisition. So be careful. We can discuss and elaborate more in the future. We just kind of talked about some of this stuff. Just remember one thing, this is really important. What exchanges? Is it the ownership of the property, trust, the LLC? I mean, what does the exchange? The answer is it's the taxpayer. So how do you identify a taxpayer? By the tax ID number. So the LLC might have its own, or it might be something called a disregarded entity or a non-disregarded entity. So we'll talk more about that on how an LLC can operate, or can LLCs break up and people go separate ways and some exchange and not exchange. We don't have time for that today. That all takes time, but we'll be happy to talk about that more in the future. Just remember, the seller is the taxpayer, the tax ID number of the ownership of the property. So that same tax ID number must also do the 1031 tax deferred exchange. That's how the government sees that it's been a sale and a purchase under the same entity, not the name, but the tax identification. You got to be careful if you're going to move into the property. Don't answer those questions. Let CPAs do it. We're just out of time. So I'm going to go right to the end and right to the point. I've got these marketing letters. I would be happy to give you if you send me an email requesting it. So in blue, you'll see on the right, teamphil@ax1031.com. You'll be working with me or Adam, my partner. Adam is my teammate under Team Phil, and we both share the same email. And the bottom line is he's very quick to respond on those emails, sometimes faster than me. If you have a question, my direct line is area code 323-570-1031, or you can just simply take a picture of this page, or there's that QR code again. Take a picture of that. This stuff will come right back up. Request the letters. If you need information for somebody who's thinking about exchanging and they need education on that, we'll be happy to provide that to them, and they could actually call us back, and we will be an extension of you and explain to them how the 1031 works, because that's all we do. Thank you for this opportunity to have myself and Asset Exchange speak with you today. I hope this has been very helpful. I hope this will generate new business for you because, folks, we're in the second half of the end of 2025. This year is going to a close. So what are you going to do to generate more business for yourself? I think maybe thinking about working with investors is a great way to go. But thanks everyone for coming in and being a part of us today. And I hope you have a good afternoon. Take care. Bye-bye.